Good afternoon, ladies and gentlemen. This is Mehmet Aksoy from QNB Financial Services. I would like to welcome everyone to United Development Company's fourth quarter 2020 financial results conference call. On this call from UDC, we have Mr. Mahir Omar Naim, who is the Executive Director of Financial Planning, and Mr. Karim Farhat, Financial and Business Planning Director. We will conduct this conference call first with brief comments on the presentation, followed by the Q&A. I will now hand the call over to Mr. Naim and Mr. Farhat to get us started. Mr. Naim, Mr. Farhat, please go ahead.
Okay. Good afternoon, everyone. This is Mahir Naim from UDC. Let us start with providing a snapshot on the company's performance for the year 2020. United Development Company has achieved a net profit of 266 million or 265 million, which as compared to 458 million of prior period. And the net profit attributable to the equity holder is 226 million, with a total revenue of almost 1.2 billion. The net profit, as it is witnessed, is lesser than prior year by 40% plus. This is indeed due to the reduction in revenue, which is lesser by 33% than prior period. And this is due to the main reason for the decline in revenue is to the outspread of the coronavirus, which had a negative impact on the company's overall operation from a sales point of view and a revenue recognition accordingly. Moreover, the company has announced a proposed dividend of 5% of the share bar value, which is equal to 5 dirham per share, with a total dividend of 177 million, equaling almost to 78% dividend payout ratio on compared to the net profit attributable to the equity holder of the company. Let me start again. Let me also continue speaking about the development activity. Despite the outspread of corona activity, our development activities have not stopped. All our projects are ongoing. There is some delay in other projects due to the difficulties that the contractors facing from shortage of labor, from securing the necessary material, the procurement from outside, and these all impacted the progress. However, no project have stopped, and we are working with the recovery plan, and the completion date hopefully will be met as planned. So we will be contributing heavily towards the end of 2022 by major projects being completed, and they will be ready for revenue recognition. So I leave the floor to you. Should you have any question, please go ahead. Hello?
Operator, can we initiate the Q&A session, please?
Yes, sir. Ladies and gentlemen, if you would like to ask a question, please signal by pressing star 1 on your phone keypad. If you're using a speakerphone, please make sure your mute function is turned off. Once again, please press star 1 to ask a question. We have our first question. Please go ahead. Your line is open. Mr. Shabir Kagalwala from Al Ryan Investment.
Thank you, gentlemen, for the call. I have a couple of questions. First, could you give us some idea of how the occupancy is panning out currently for your residential and commercial places? Second question is that in the fourth quarter of 2020, you recorded a very high gross margin, about 73%, which was probably one of the highest since 2019. Could you give us a sense of what led to this gross margin expansion in the quarter, and how do we see the gross margins going forward? Thank you.
Thank you very much. In respect to the occupancy, the occupancy as of now, they are based on the current challenges that the market is facing, is considered acceptable on both retail and residential. Due to the corona outbreak, certain residents have left the country because they lost their job and so forth. So we are okay and hoping to be improved in the year 2021 towards, if wishfully speaking, that coronavirus hopefully will be disappeared. So from an occupancy point of view, it is considered to be good within the current market situation. As for the profitability and the gross profit for Q4, the real estate, when you recognize revenue recognition, is mainly determined on the handover. So there has been handover of certain real estate properties as of the year end, and accordingly the revenue has been increased and the gross profit have been increased accordingly in relation to the recognition. So you can sell, or a sale can be concluded for a real estate property, but if the rewards and risk are not transferred, which no physical handover is made, then there will be no revenue recognition. Going forward, yes, we are somehow optimistic, hopefully, for the year 2021. Should there will be no surprises on the new thing about corona, we are optimistic that things shall be better than the year 20. Now I think the whole market is watching out, and all of us are hoping that there will not be another major impact, negative impact on corona outspread again. And if this does not materialize, hopefully the year 2021, should the plan and the revenue that we are planning to recognize via our budget is realized, things will be better than 2020.
Thank you. I have two follow-ups on that. Firstly, which project did you start handing over? And secondly, the residential occupancy had declined up in the first 9 months from like 60% to 50%. Where does it stand currently? Thank you.
Now, handing over, as I told you, it's handover of plots, handover of units. The revenue recognition is based on the individual sale of units. It's not a project per se. Al-Muttahida Tower project will be handed over, hopefully the units of Al-Muttahida, through the Q2 of year 2021. So it was mainly handover of more of residential units and land plots, which contributed to the revenue recognition. As for the residential occupancy, we are within the same range as you mentioned, within the 50%, and we are hoping things will be better and more stability will be on the market, and in respect to corona, and hopefully things will go back to normal, and we are hoping that the occupancy will be increased in the coming years and so.
Okay. Thank you. Thank you, gentlemen.
You're most welcome.
Thank you, sir. Our next question comes from Mr. Anastasios Dangianakis from Al Sasan.
Yes. Hello. Hello. Good afternoon. Could you please let us know, you spent in work in progress $1.04 billion in 2020 and raised 700 million, half a billion, sorry, in net increase in loans. Now, given you want to finish all projects by end of 2022, could you give us the balance of spending you plan till 2022 and how much more debt you plan to raise to fund this balance? Thank you very much.
Well, I'll answer the first part and then I'll let Karim answer the second part regarding the debt. It is obviously the increase in work in progress is a positive indication of the increase of the percentage of completion of the project. So this is very much expected as long as the projects are being executed. So the work in progress, yes, increased compared between 2019 and 2020 because the magnitude of the work being performed is higher and the tendency is higher, and accordingly the percentage of completion is higher. As in respect to the completion of the project, the majority of the projects we are planning to finalize them and complete them by 2022, but there will be other projects that are still part of Juwan Island will be completed post the year 22. And in respect of the financing, all of our current projects are financed and funds are secured through financing and equity. It's a mix. And if there is anything needed for any upcoming projects, of course we shouldn't be having any issue in respect to raising funds. Karim, if you want to add anything about this, please go ahead.
Just to mention that our current debt to equity ratio is 34%, and which is low comparatively. And we fund ourselves, as Maher said, all the projects are project financed and funded, but sometimes we don't go with full drawdowns on them, and this is why our debt to equity ratio is low. Reason being, it depends on pre-sales. So the more we have pre-sales and collections, so it's a mix between consuming our limits that we have in debt and pre-sales. So basically, this is why you have your work in progress a bit higher than how much, if you're comparing it, how much debt has been drawn down. But over and above, all the projects are funded regardless. There are limits available for them, and it's within the limits of the balance sheet that will stay below 55%.
So if I may, just to clarify, from the 3 billion original target as per 2020 at the beginning planning, we spent now 1 billion. So the other 2 billion, will it come in 21 and 22 or spread out more? And from the debt to equity, clearly it's 50% from debt. 50% of debt will continue of additional expenditures. Thank you.
No, you have repayments on this one. What you have basically repayments that will happen. So whatever comes from that, the projects that you're talking about are multiple projects, and they have different timings with different maturity dates. So some projects that are being handed over, for example, to their third party, and it had a debt during the previous construction, upon the collection of the final amounts, those debts will be repaid. The new developments that are going through, this is where will be getting more outstanding debt that you will see on your balance sheet. Eventually, what we always try to maintain is an optimum ratio up to 50-55% at max. But currently we are at 34, and obviously we've been enjoying that debt to equity ratio for the past couple of years due to our pre-sales and prior collections. So the debt profile that you would see up to 3 billion, yeah, definitely it will have like a bell curve, which will increase over 21, 22, 23, then it will go down.
Okay, thank you.
You're welcome.
Thank you, sir. The next question comes from Mr. Monil Sangawi from Axions Consulting. Please go ahead, sir. Your line is open.
Sure, thanks. Thank you for holding this call, first of all. I wanted to ask two questions right now. First, that you mentioned that there would be delay in other projects due to the COVID year. So, could you please put some light into what projects are we looking delay in handing over the project? And other than that, I would also want to ask that the gross margins have increased year over year for the entire year of 2020. What is this sustainable, or what kind of guidance are we looking at margin levels? So yeah, thanks.
Just let me give an insight. When I mentioned about the delay, what I meant is the delay on milestones, but it's not the overall completion of the project. We have a recovery plan, and bear the current recovery plans, the projects will not be significantly delayed, and the majority of which will be completed within the planned target. But as I said, contractors, they suffered throughout the year from shortage of labor, from difficulties in procuring materials from outside and construction material and so forth. But for us, there is no major worry nor a concern about the completion of the projects, because as of now, as we speak now, the projects are going to be completed based on the recovery plan. Hopefully there will be no major change on the current situation of Corona, and Corona will not be outspread in a more velocity, and that might impact the overall world business, not only the state of Qatar or UDC or real estate companies. From a margin, hopefully this will continue to be sustainable. This is within our target, and this is within our range, and whatever achieved is based on our financial projection and plans, and hopefully this can be sustainable throughout the years.
Sure, thanks. A follow-up question on that. Are we talking about gross margins being sustainable, or are we looking at EBITDA margins and the net margins as well? And what would be the target?
Our EBITDA margins are pretty much stable. If you look at them, and they're around 40%. As far as the gross margin is concerned, you need to know that our revenue is composed of 4 or 5 main revenue streams that do have different margins, depending on the product itself. If it's a land, it's an apartment, or it's a leasing revenue, or if it is a margin that's coming from a utility income like Qatar Cool. So those margins, on the gross margin level, you will definitely find sometimes basically a change that will, a unique change that will go there, depending on which product is being sold and when it's being launched. We always opt to try to maintain stability on our EBITDA margins and our gross margins, but to a certain extent, sometimes it is guided by which product we're selling and at what time, not just the market price.
All right. And what would be the targeted growth levels, bottom line growth levels? Are we expecting any? What is the target bottom line growth levels?
We cannot disclose this, can we? We are a public shareholding company. We cannot disclose what is the targeted growth, but hopefully there will be a growth. Should things stay as is and there are no surprises in respect to the current situation.
Sure, thanks.
You're welcome.
Thank you.
You're welcome.
Thank you, sir. The next question comes, is a follow-up question from Mr. Shabir Kagalwala. Please go ahead.
Gents, I had a follow-up. We have seen that the net debt to EBITDA has gone up in this year, mainly because the EBITDA has declined and the debt levels have gone up. Just wanted to know if there are any loan covenants in your loan agreements on that. And the second question is on the infrastructure profit. We have seen that infrastructure and utilities have a flat earnings in this year. That's good. Wanted to know about the outlook of
of this segment for 2021? Thank you.
Karim, go ahead and answer in respect to the debt risk, please.
You're basically, yes, true. We have taken more loans, and our earnings went down this year, which is a normal thing that happened. But usually we maintain the same thing that we have maintained in 2019. This is what we expect going forward. And for the second, you've been asking about our flat on our utilities income, I believe, Shabir.
Yes, infrastructure and utilities.
Yes, and also on the
this is basically utility, which is Qatar Cool, and the revenues from those are pretty much stable, and has a normal growth rate as traffic comes in and more connections come in.
Right. So the outlook will be it will have a similar range for 2021.
It has a steady increase. Usually the utilities as long as more people connect, you can look at it as the demographics of the whole country.
Yes.
Right. And about the loan, are there any loan covenants which are embedded in your loan agreements for this, or there aren't any?
No, we don't have. No, there aren't any. Our structures are mostly project finance. And we don't have we don't have much on the corporate, which is one corporate, and we are way far off from any covenants that crosses those limits.
And is there any internal target to debt to EBITDA?
We don't have an internal target right now since we're a bit far from it.
Okay. Thank you.
You're welcome.
Thank you. We have no further questions at this time. Mr. Aksoy, please go ahead.
Hi, this is Mehmet Aksoy again. If there are no further questions, then we can wind up the call for today. I would like to thank everyone for participating in the call. Please do reach out to team at QNBFS or UDC if you have any further questions. Thank you.
Thank you very much.
Thank you.
Thank you, everyone. You may now disconnect. Thank you for your participation today.
Thank you.
Thank you, everyone.